Welcome back. You can, of course, go to economist.com.na if you want to listen to previous interesting and very informative and educative conversation happening between Mr. Daniel Steinman and myself on EconoChat. Let's talk business with Mr. Daniel Steinman. Today we are talking deficit and also the role the deficit actually plays on the national budget. But also, Mr. Daniel Steinman, before we went on a break, you did mention a few terms like the capital, the rates. Exchange rates, you mentioned it, but you didn't elaborate on that. But the question is, how does the deficit impact the exchange rates?
Okay, let's look at the aspects of the deficit beyond the immediate fact that you need to finance it. Remember now, the deficit is an integral part of the budget. So we've been running deficits for since Thy Kingdom Come, forever. Botswana had a surplus for a long spell. But even Botswana, with their surplus-based economy, had to start running on budget deficits in 2016 or 17, if I remember correctly. So there are a few exceptions of governments actually budgeting for a surplus. But there's also a catch, and that's usually where people are only half informed or not informed at all, is that is an operational surplus. And if you bring all the elements into it, it usually turns into a deficit. And the moment you have a capital market somewhere, it means that bonds are being sold. So the government is selling its debt and it's financing something. So I don't want to dwell too much on Botswana now. I just want to leave you with the thought that even countries that claim they budget for a surplus, it's not the truth. Or it's not reality. They only budget for an operational surplus, but not for a complete surplus. So there's a capital market where government debt is being sold in the form of bonds, there's a deficit. And what happens now is, if your deficit is too big, if it's unmanageable, if you can't every, let's say 2 or 3 out of 10 years at least budget for a break-even year, it means that you are not in control of your expenses. Which sounds like most Namibians to me. But if you're not in control of your expenses, and you have to continuously, every year, go and borrow 16 billion, 17 billion, 18 billion, and you don't really pay them back, you just roll them over, meaning you just give out new bonds with longer maturities, like the GC45, for bonds that are due next year and the year after that.
And the interest rates?
It's called a switch auction. Switching from a short maturity bond to a long maturity bond. Okay. And if you are not in the position to get to break even in your budget, it means that you have to continue borrowing. It means that the money that you borrow, it gets added to your debt. So your debt grows all the time. So you think when you are at 14%, we can borrow as long as we like, as much as we like. Then at some point you get to 50%. Then you see, it's just growing and growing. The debt is just becoming bigger and bigger. And in a certain sense, in a philosophical sense, if you borrow from the capital market by selling government bonds, and you don't invest that money, but you consume it, like what's been happening in Namibia since 2016. So it's now 6 years that we haven't been borrowing to invest, to build infrastructure, to build schools, to build hospitals. We've been borrowing to pay salaries and to pay interest on old debt. So now the capital market is turning into a cash loan for the Namibian government. So can you see the red lights flashing? The the risks are growing and growing, and the dangers are becoming bigger and bigger. So the question is, how do you finance it? You finance it from the capital market, you finance it by borrowing money, and this accumulates debt over a period of time. And we are now in the region, depending on how you measure it, of anything between 72 and 75%. Although I read in the week on the World Bank website that they regard Namibia's foreign debt already at 82%. The reason is they bring the government securities into it, where government had to give security for certain projects or certain loans or whatever. So let's say it is somewhere between 75 and 80%. It is not a calamity, not yet. But what we need in this new budget is a very clear indication. We need guidance on the trajectory that our deficits are going to follow for the next 4 or 5 or 6 years, because a deficit and growing debt has a very direct impact on the exchange rate. The bigger your debt becomes, the weaker your currency. And what happens in Namibia? We import most of the stuff. So what did we see now the last year and a half? Inflation. If we didn't have deficits for 20 years, we wouldn't have had this terrible inflation.
Well, Mr. Daniel Steinman, unfortunately time is not on our side, because I really wanted to ask you what your expectations are for the national budget for 2023. But I think we can still talk about it. Even if the budget has been tabled, we can still talk about it. What you really expect from our government when it comes to our national budget. But thank you so much for taking the time off once again to inform us and educate us. And we will meet again next week. From me, Elsa Bitimnyani, I say ta-ta.